tens of thousands of dollars simply disappear for many people because of one serious flaw. Retirement withdrawal mistakes unfortunately impact countless individuals, preventing financial security. Many people begin taking money too early. This often happens before the age of 59 and a half years. The Internal Revenue Service imposes a 10% penalty on these early withdrawals. This is a severe financial hit. Losing 1/10 of your savings just for withdrawing early is painful. This penalty comes on top of your regular income taxes. It is a double whammy to your financial well-being. For example, if someone withdraws $30,000 early, they might pay $3,000 in penalties. They also face thousands more in taxes. A $5,000 early withdrawal could mean $500 lost to penalty alone. This common mistake ruins many early retirement plans. Another huge problem is ignoring required minimum distributions, or RMDs. Once you reach 73 years old, for most people, the government insists you start withdrawing money from traditional IRAs and 401s. Failing to take these RMDs carries a 25% penalty on the amount you should have withdrawn. Before 2023, this penalty was a staggering 50%. Think about owing a quarter of your necessary withdrawal back to the government. If your RMD was $8,000, you would owe $2,000 in penalty. This is a substantial drain on your retirement funds. Many individuals simply forget these crucial rules. They might believe their money is safe in their accounts forever. It is not the government expects its tax revenue. A very subtle but dangerous mistake involves the sequence of returns risk. This occurs when significant market downturns happen early in your retirement years. If you are withdrawing funds while investments drop, you lock in losses forever. This can permanently damage your portfolio's ability to recover. Suppose your $1 million portfolio drops 20% in year one. If you withdraw $40,000, you sell shares at a loss. This reduces your investment base significantly. Studies show a 70% chance of failure for a 5% withdrawal rate over 30 years becomes much higher with bad early market returns. A 5% withdrawal from a $1 million portfolio is $50,000. If the market drops 10%, you are now taking $50,000 from $900,000. This quickly accelerates portfolio depletion. Not understanding tax implications is another very costly error. Different types of accounts have different tax treatments. Roth IRAs are tax-free in retirement if conditions are met. Traditional IRAs and 401ks are taxed as ordinary income. Capital gains from brokerage accounts have different rates. Withdrawing too much from a traditional IRA could push you into a higher tax bracket. This means a larger portion of your money goes to the government. A single person might be in the 12% bracket on income up to $44,725. An extra $50,000 withdrawal could push them into the 22% or even 24% bracket. This changes hundreds or thousands of dollars in annual taxes. Over-reliance on the 4% rule is also problematic. This rule suggests you can withdraw 4% of your starting portfolio balance each year, adjusted for inflation, and have a high chance of not running out of money over 30 years. However, this rule originated from studies in the 1990s. It assumes a specific market environment. It does not always hold true today. With lower expected returns and longer lifespans, a 3% or even 2.5% withdrawal rate might be much safer. A 4% withdrawal on a $1 million portfolio is $40,000. If returns are low and inflation is high, that $40,000 might become unsustainable. One study revealed only a 58% success rate for the 4% rule in recent market conditions. That is almost like a coin flip for your entire financial future. Ignoring inflation is a silent killer of purchasing power. The cost of living consistently rises by 2% to 3% per year. On average, what $500,000 buys you today will buy significantly less in 20 years. A loaf of bread costing $3 today might cost $6 in 25 years. If your retirement withdrawals do not keep pace with inflation, your lifestyle will slowly but surely degrade. Your initial $40,000 withdrawal will feel like $30,000 or $25,000 in real terms after 2 decades. This erodes your spending power dramatically. Most people fail to account for this long-term erosion. Failing to have a clear withdrawal strategy causes many retirees to pull money haphazardly. This leads to inefficient tax planning. It also exposes them to market volatility without adequate protection. A well-designed strategy considers different types of accounts, their tax implications, and current market conditions. It prioritizes withdrawals from taxable accounts first, then tax-deferred, then tax-free, for example. This is known as tax diversification. Without a plan, you might be leaving thousands of dollars on the table. One financial planner reported clients save $7,000 annually by optimizing withdrawals. Over a 20-year retirement, that is $140,000 lost to poor planning. Another critical error is not planning for escalating healthcare costs. Healthcare expenses can easily be a retiree's single largest expenditure. Medicare covers many things, but not everything. Out-of-pocket costs for premiums, deductibles, and copays can amount to thousands of dollars every year. A couple retiring at 65 might need $300,000 just for healthcare expenses throughout their retirement. This figure does not include long-term care, which can be extremely expensive. A single year in a nursing home can cost over $100,000. Ignoring these numbers is a recipe for financial disaster. Many retirees underestimate these costs by tens of thousands of dollars. Panicking during market downturns and selling investments is a classic and very damaging mistake. When the stock market drops 20% or 30%, people get scared. They sell their holdings, locking in irreversible losses. This prevents them from participating in the inevitable recovery. History shows the market has recovered from every major downturn it has ever faced. Missing just the 10 best days in the market over 20 years can halve your total investment returns. If your portfolio was $1 million and you sold during a 30% drop, you would have only $700,000 left. Then, if the market rebounds, you miss all those crucial gains. This leads to permanent wealth destruction. Not diversifying income sources is also very risky. Relying solely on your investment portfolio or Social Security can be dangerous. Social Security typically replaces only about 40% of pre-retirement income for average earners. Having multiple income streams, like a small part-time job rental income or a pension, provides a much-needed financial buffer. This reduces pressure on your investment portfolio. It also provides flexibility during market volatility. Many retirees realize this point far too late. They find themselves short of cash when their primary income source dwindles. Failing to update beneficiaries is a bureaucratic but incredibly important oversight. After a major life event, like a marriage, a divorce, or a death, beneficiaries need to be updated on all retirement accounts. If your former spouse is still listed, they might legally inherit your money instead of your current loved ones. This causes significant legal battles and immense heartache. It is a simple administrative task that can save tens of thousands of dollars in legal fees. It ensures your final wishes are followed. This one common error impacts thousands of families every year. Not having an adequate emergency fund outside retirement accounts often forces early withdrawals. Experts suggest having 6 to 12 months of living expenses readily available in cash. If an unexpected car repair or medical bill arises without an emergency fund, you might be forced to tap into your IRA or 401k. This triggers taxes and potentially early withdrawal penalties. A $5,000 emergency could cost you $600 in penalties and taxes if pulled from a tax-deferred account before 59 and a half years old. This creates a stressful cycle of financial problems. Falling for financial scams targets retirees disproportionately. Scammers often promise impossibly high returns or demand personal identifying information. Elderly individuals lose an estimated $3 billion annually to fraud. This is an absolutely huge sum. These scams can wipe out a lifetime of savings in an instant. Always be skeptical of unsolicited offers. Never share your Social Security number or bank details with unknown parties. Financial exploitation preys on vulnerability. Another mistake is ignoring your spouse's needs or preferences. Retirement planning is a joint venture. One partner might dream of extensive travel while the other prefers to stay at home. Disagreements over spending can cause serious problems. It is crucial to have open conversations about financial goals and withdrawal strategies. A shared understanding prevents stress and ensures both partners feel secure. This collaboration can prevent costly financial missteps involving tens of thousands of dollars. Not working with a qualified financial advisor can be a very costly omission. A good advisor helps navigate complex tax laws, RMDs, and intricate investment strategies. They provide objective advice and help avoid emotional decisions during market fluctuations. While advisors do charge fees, these fees are often offset by the financial benefits they provide. A recent study showed people working with an advisor had 15% more wealth over time. This could mean an extra $150,000 on a $1 million portfolio. They help optimize withdrawals, ensuring you keep more of your money. Many people believe they can do it all themselves. They often learn this painful lesson the hard way. The cost of not having an expert is usually far greater than the cost of hiring 1. They help plan for long-term care expenses, for example, which can deplete savings by hundreds of thousands. They guide you through setting up a diversified withdrawal plan. This strategic planning prevents hundreds of thousands in potential losses over retirement. The wrong withdrawal order also costs many retirees dearly. Withdrawing from your tax-deferred accounts too early leaves them less time to grow tax-deferred. Using your taxable accounts first, followed by tax-deferred, then tax-free accounts like Roths, is often the most tax-efficient method. This allows your tax-free money to grow for the longest possible time. A wrong order could mean paying thousands more in taxes than necessary each year. Over a 20-year retirement, this adds up to significant figures. It is a highly nuanced process. Failing to consider potential changes in life circumstances is another pitfall. Health issues, family emergencies, or unforeseen expenses can derail even the best retirement plans. Building flexibility into your withdrawal strategy is paramount. This means having some liquid assets or a conservative withdrawal rate to absorb financial shocks. If your plan is too rigid, a single unexpected event could trigger significant financial distress. This essential flexibility often saves tens of thousands of dollars. Being too conservative or too aggressive with investments in retirement is equally problematic. Too conservative means your money might not keep pace with inflation. Too aggressive means you risk significant losses during market downturns. A balanced approach with a mix of stocks, bonds, and cash is often recommended. This balance protects against both inflation risk and market risk effectively. It ensures your portfolio generates enough income without taking on excessive risk. One wrong investment move can cost many thousands of dollars. Neglecting spousal Social Security benefits is a common oversight. Spouses may be eligible to claim benefits based on their partner's earnings record. This can significantly increase household income during retirement. Understanding these rules and optimizing claiming strategies can add thousands of dollars to annual income. Many couples leave tens of thousands of dollars on the table by not coordinating their Social Security claiming decisions. It requires careful calculation and precise timing. Not having a will or an estate plan can create chaos and substantial financial burdens for your heirs. If you die without a will, your assets will be distributed strictly according to state law. This might not align with your wishes. This can lead to costly probate proceedings and bitter family disputes. Estate planning ensures your assets pass smoothly and tax efficiently to your chosen beneficiaries. The legal fees and taxes associated with an unorganized estate can run into tens of thousands or even hundreds of thousands for larger estates. It is a vital component of holistic retirement planning. This common neglect impacts thousands of families yearly. Many older adults keep too much cash. This might feel safe, but inflation relentlessly erodes its value. Cash earning 0.1% interest, while inflation is 3%, means you lose 2.9% purchasing power annually. A $100,000 cash pile loses nearly $3,000 in real value each year. This is a subtle but constant financial drain. Misunderstanding annuity products is another frequent issue. Some annuities offer guaranteed income for life, which sounds very appealing, but they can be incredibly complex with high fees and steep surrender charges. They might also severely limit your access to your capital. A poor annuity choice can lock up hundreds of thousands of dollars in a product that does not truly meet your needs. Thorough research is absolutely vital before committing to such a long-term financial product. Not planning for rising long-term care costs is a major and frequently ignored mistake. The average cost of a semi-private nursing home room is $93,000 a year. Home health aid services average over $60,000 annually. These massive costs are often not covered by traditional health insurance like Medicare, without a plan like long-term care insurance, or dedicated savings. These expenses can rapidly deplete retirement funds. Many people ignore this until it is far too late. This significant oversight costs hundreds of thousands of dollars. Leaving a large legacy to heirs without tax planning can result in substantial estate taxes. Depending on the size of the estate, federal estate taxes can be 40% or more above certain thresholds. Smart planning can effectively mitigate these taxes, preserving more wealth for your beneficiaries. Without planning, tens of thousands or even millions can be lost to unnecessary taxes. This requires careful consideration and professional guidance. Being unaware of Medicare enrollment deadlines can unfortunately lead to penalties. If you do not enroll in Medicare Part B within a specific timeframe after becoming eligible, you could face permanent late enrollment penalties. This means paying a higher premium for the rest of your life. For example, a 10% penalty for 5 years of delay means a permanent 10% increase in your Part B premium. These penalties accumulate to thousands of dollars over many years. This is a very common administrative oversight for retirees. Not reviewing your retirement plan regularly is another serious flaw. Life circumstances change, market conditions shift, and tax laws constantly evolve. What was a good plan 5 years ago might not be optimal today. Annual or biannual reviews with a financial professional are absolutely crucial. This ensures your strategy remains aligned with your goals and the current economic environment. Ignoring this essential review can cost tens of thousands of dollars in lost opportunity or inefficient planning. Delaying Social Security for too long without good reason is sometimes a mistake. While delaying up to age 70 increases your annual benefit by 8% per year beyond your full retirement age, it is not always the best strategy for everyone. If you have health issues or need the income sooner, taking it earlier might be more advantageous. Waiting too long could mean missing out on tens of thousands of dollars in benefits you could have already received. Each individual situation is truly unique. Not considering a reverse mortgage carefully can be detrimental for many homeowners. While a reverse mortgage can provide income, it also comes with various fees and can significantly erode home equity over time. It is a complex financial product that is not suitable for everyone. Misunderstanding its intricate terms can lead to significant financial disadvantages. Always seek independent financial advice before committing to a reverse mortgage. This substantial financial decision can impact hundreds of thousands of dollars in home equity. Failing to consider charitable giving strategies can mean missed tax benefits. For those who are charitably inclined, using qualified charitable distributions from an IRA or a donor-advised fund can effectively reduce taxable income. This allows you to give efficiently and keep more of your money. Without these smart strategies, thousands of dollars in potential tax savings are often lost. It is a very intelligent way to maximize both generosity and financial efficiency in retirement. Underestimating the emotional impact of retirement is often a greatly overlooked factor. Moving from a busy work life to full retirement can be a huge psychological adjustment. Some retirees struggle significantly with the loss of identity or purpose. This can lead to impulsive financial decisions or even overspending to fill newly found free time. Emotional well-being directly impacts financial well-being. Having a plan for this personal transition is just as important as the financial plan itself. A sudden change in spending patterns without a financial plan can completely derail a carefully crafted strategy. Being too generous with family members without budgeting is another common mistake. While helping loved ones is certainly admirable, it should never jeopardize your own financial security. Lending or gifting large sums without a clear plan can rapidly deplete your retirement savings. Experts strongly advise setting clear boundaries and defined amounts. Many retirees find themselves in a precarious financial position after assisting family without proper financial planning. This can involve tens of thousands of dollars. Not having adequate property and casualty insurance can be catastrophic for your assets. Homeowners insurance, car insurance, and umbrella policies protect your valuable assets from unforeseen events. A major lawsuit or a natural disaster can wipe out years of savings if you are underinsured. An umbrella policy offering $1 million in liability coverage can cost only a few $100s annually. This small expense protects against a multi-million-dollar catastrophe. It is a truly critical safety net for your retirement. Ignoring the impact of rising interest rates on bond portfolios is incredibly important. As interest rates rise, bond prices generally fall. If you hold a significant portion of your retirement savings in bonds that are not managed effectively, this can lead to substantial capital losses. Understanding bond market dynamics is absolutely crucial in retirement. A simple shift in interest rates can reduce your bond portfolio value by thousands of dollars. Not having a power of attorney for finances and healthcare is a significant risk for everyone. If you become incapacitated, someone needs to manage your financial affairs and make crucial Without these essential legal documents, your family may have to go to court, which is both time-consuming and extremely expensive. This ensures your wishes are respected and your finances are managed effectively without costly legal battles. This foresight saves tens of thousands. Neglecting to review your credit report regularly can expose you to identity theft or costly errors. Identity theft can lead to fraudulent withdrawals from your retirement accounts. Errors on your credit report can impact your ability to get loans or services at favorable rates. Regularly checking your credit report at least once a year can prevent major financial headaches and protect your vital savings. This simple proactive act can save thousands of dollars. Failing to understand all the options for your former employer's 401k is very common. You can leave it there, roll it into an IRA, roll it into a new employer's plan, or simply cash it out. Each option has different tax implications and investment choices. Cashing out before 60 could trigger huge penalties and taxes. Rolling into an IRA often provides more investment flexibility. Making the wrong choice can cost thousands in misgrowth or unnecessary taxes. Underestimating hobby expenses in retirement can be a genuine surprise for many. Many new retirees find their hobbies or new leisure activities are far more expensive than initially anticipated. This can seriously strain budgets if not properly accounted for. Budgeting for these new expenses is crucial to avoid overspending and negatively impacting your withdrawal strategies. A new golf membership might cost thousands annually, for example. Not coordinating retirement assets with your overall estate plan is another critical mistake. Your retirement accounts may have separate beneficiary designations from your will. These designations usually supersede your will. Ensuring consistency across all your financial documents is absolutely vital. This prevents assets from going to unintended beneficiaries and avoids costly disputes. This careful coordination saves thousands of dollars. Paying unnecessary fees on investments constantly eats into your returns. High expense ratios on mutual funds or excessive trading fees can significantly diminish your portfolio's growth over time. Even an extra 0.5% in fees can cost tens of thousands of dollars over a 20-year retirement. Choosing low-cost index funds or ETFs can save substantial amounts of money. Fee awareness is a powerful tool. Not realizing that Medicare Part A is usually premium-free, but Part B and D have premiums is a common surprise for many. Part B premiums are means-tested, meaning higher earners pay more each month. These costs can amount to hundreds of dollars per month per person. Ignoring these mandatory monthly expenses will quickly deplete a retirement budget. Budgeting for these predictable costs is essential to avoid financial surprises. Delaying important maintenance on your home or car can lead to much larger expenses later on. In retirement, postponing a roof repair or a vital car service might seem like saving money temporarily. However, it often results in a much more expensive problem down the line. Proactive maintenance preserves assets and prevents sudden large expenses that could force undesirable withdrawals. This preventative action truly saves thousands of dollars. Not considering the impact of lifestyle inflation in early retirement is a dangerous trap. Some retirees increase their spending significantly in the first few years, often on extensive travel or new leisure activities. This higher initial spending can make it difficult to sustain withdrawals over a longer retirement period. A consistent and disciplined approach to spending is absolutely vital. Spending $5,000 more annually than planned for just 5 years means $25,000 less available for later retirement years. Failing to document all financial accounts and important contacts makes things incredibly difficult for surviving family members. In the tragic event of your death or incapacitation, your loved ones need to know where to find all your accounts, insurance policies, and professional contacts. Without this critical information, they will face immense stress and potentially significant financial delays or even outright losses. A simple, organized list can save thousands in administrative costs and emotional turmoil. Not understanding how capital gains taxes work on non-retirement investments is another common tax trap. Selling appreciated assets in a taxable brokerage account can trigger capital gains taxes. Depending on your income, these rates can be 0, 15, or 20%. Strategic selling and tax loss harvesting can effectively minimize these taxes. Without this crucial knowledge, you could be paying thousands more than necessary. It is a complex area